My name is Ajay Ramasubramanian, and I'll be moderating this panel. So we have an interesting one and a very diverse set of panelists. We are going to be speaking about scaling fintech platforms, and within that, enterprise revenue, consumer reach, and capital discipline. And the reason why we have chosen that, and before that, I'd like to say a big thank you to the Digital Fifth, the organizers of the Bharat Fintech Summit. It was the first time that someone has kind of printed out everything. So if anyone can read English, they can come and moderate this panel. So I haven't had to kind of even use my brain to do this. But nevertheless, some discussion pointers to kind of begin this. So how many of you here really think fintech can be broken down into enterprise fintech and consumer fintech, and they're two different worlds? There are many of them who don't believe in it, but I think from these gentlemen we'll get to know how they are different, because they invest money into those fintechs. But if you look at India's fintech story, between 2024 and 2025, if you look at the overall investments in India's fintech ecosystem, it has gone up from about 1.3 billion USD to about 1.7 billion. and two of the larger areas in which funding has kind of gone in is enablement platforms, which is one, and the other one is everything to do with regulation and compliances. But if you look at how the fintech ecosystem has evolved, from what we have seen over the years of rapid expansion, it is now kind of moved on to something which focuses on scale, resilience, and how can you create value over a longer term. And that's where probably, if you look at the topic that we're going to talk about, revenues coming in from enterprise, the overall consumer reach and capital discipline kind of comes in. Gentlemen, if you can very quickly kind of introduce yourselves in a couple of lines. Hero, we can start with you.
Yeah, thank you to Digital Fifth for having me here. My name is Hero. This year I'll finish 20 years of investing. Started in Chicago, New York, was a public market hedge fund portfolio manager. And have been at BNext for 7 years. Last 5 years in the stealth, we also have built out early growth fund called Accelerate Fund, from which we underwrite $5 to $20 million checks, mostly in Series B and C, and work with companies to scale many of these businesses. And in fintech specific companies with which I'm associated and I work actively are our portfolio companies, Bharat Pay, M2P, Raise Holding, Dhan App, Fi Commerce, M1 Exchange, Sopse, and many more. So that's me.
Yeah, good evening, everyone. My name is Gaurav. I've been in private equity investments for about 17 years, been with various funds. I think now part of Hero Enterprise. It's an investment office for the company headed by the chairman, Mr. Sunil Kant Manjal. And I think the idea is to invest flexibly in terms of ticket sizes and stages, right from early stage to growth stage, across 4 or 5 major areas, which are the pillars of how India is growing in the future. Thank you.
Hi, everyone. My name is Anand Prasanna. I'm with Iron Pillar, one of the partners here. We are a growth stage tech fund in India. We have been around for almost 10 years now, investing in companies which are typically, from a revenue perspective, 100 crores and larger, but we could be investing in a business which is at $100 million in revenue. Typically, our initial checks are anything from $10 million to $25 million. On some of the winning companies, we have put in 50, 75 million kind of checks also as these companies scale up. Primarily, we are focused on founders who are building product in India, but to kind of touch upon the enterprise versus consumer piece, most of our investments are in enterprise tech businesses, which not just build for the Indian market, but also for global markets.
Hi, everyone. Good evening. My name is Varun. So I work for Warburg Pincus, which is a global private equity fund. I lead our software, fintech, and payments investments. So in terms of portfolio companies that I help manage that are relevant to this discussion, I sit on the board of Perfios, which is one of the scaled fintech infrastructure players in India. So look forward to bringing those perspectives to the discussion today. Thank you.
Great, thanks, gents. And I'm pretty sure most of you in the room was also here when Deepak Sharma was presenting and giving a talk. And I think a lot of things that Deepak spoke about pretty much resonate with the broader discussion of this topic. And it cuts across how or why fintech platforms need to balance their growth ambition with capital discipline, why scale is important, why profitability comes in. I'll go to my first question. So we are going to, so we have divided this into 3 parts or 3 segments. The first segment is more to talk about growth models at scale and why or where speed, predictability and economics come in. Maybe I'll start with you, Varun. At what point does growth velocity actually become a risk rather than a strength when you're looking at a platform business?
Yeah, sure. So the way I see it, I think we are all in the game of innovation. We're looking to churn out products at an extremely fast pace. Speed to market is extremely important. But sometimes when we're trying to do that, we all miss out on some of the basic things around some boring aspects around like compliance, info security, a scalable architecture that will not just solve you for the next 12 months, but sets up the platform for the next 4 to 5 years. So I would just encourage all of you to kind of think about that as well, because I mean, you've seen this time and again across fintechs. One knock from the regulator can set you back many years and have a permanent dent on you. So I would just say, while it's great to kind of innovate at speed, let's not forget that a lot of enterprise fintech businesses, banks, all the leading financial institutions, they want to hand over their business to a safe pair of hands. So I would encourage all of us to kind of remember that as well.
Thanks, Varun. So Anand, typically many of the companies and some of them that Hero spoke about, some of those portfolio companies, like whether it's an M2P and the likes, raising a few rounds, they probably raise their growth capital from you. The business is pretty much established. They're not kind of figuring it out. They've raised money which says that there is this trust that they've built. There is a customer base that they have. There are good solid revenues. But still when they raise that round of growth capital from someone like an Iron Pillar, moving or making that shift from a early stage company to a growth stage company, what fundamentally changes first? Is it the power of pricing? Is it you try to bring in more efficiency into place? Is it you try to focus on the operating leverage that they can have to kind of move on to the next level? What is it that you would look at?
So in growth stage, there are typically 2 kind of businesses which you end up seeing, right? And part of it is the function of the TAM that people are going after. So imagine if you're looking at a company which has got 25 million revenue, and you could say, oh, at 100 million, this is a large company. But the TAM they're going after is a 5 billion. It's actually not a large company. It's a 2% of the market. So versus something where the TAM is actually much lower, it could be a consequential company in that space. So first thing for us is actually really looking at a business and really understand what are they building. Because a one approach fits all doesn't really work if they are raising a Series B or Series C. So typically if it is a business which has got like a reasonable level of scale, okay, here it is very clear that this company is actually already breaking out at the number 2, number 3 in that particular category. And this is a place from where they can just have a compounding growth and they can continue to stay and have a shot at number 1 or number 2 in a particular category. Yes, sure. Then you're really looking for operating leverage. Are you actually moving from, say, minus 10 or 15% EBITDA to are you moving from here in the next 2 years to a positive EBITDA? Are you going to be some hitting metrics where public markets are going to look at you, or private equity, somebody like Warburg Pincus would be excited at you at 4x's revenue? That's the question which you would ask. But that's not the only question, because there are other people who may be really going. So there is one kind of companies which what we think as they build for like total niches. A global example which any of you would know is actually NVIDIA, right? So if you were looking at NVIDIA 10 years back and you're really thinking about that, oh, I'm looking at a company which is making gaming chips, you just completely missed the plot. Because they were really building parallel compute power, which can be used in a very large use case. And in the first 15 years of trying to build that, they did not even know what exactly would that large use case would be till a particular paper came out from two guys sitting in Toronto that this is a use case. So there are companies like that which are really building out today. And the unfortunate problem is when an investor goes into those companies with a 5-year view. If you ask Jensen Huang, the 20-year journey he had at the public market, the first 20 years, where he was trying to almost got fired by activist investors. Those kind of companies, if you see, you really have to kind of really tell them, okay, fine, this is a niche, you're going in, go for it. You may have to continue to plow all your profits back. It's a very hard problem to solve. But if India have to build $100 billion companies, that's a second pot where you have to look for. It's not the companies which are going to break even and giving you 20% EBITDA at 100 million revenue. It is actually the other ones, which will actually become very big outcomes.
Yeah, I think even in the context of Indian fintech, probably, if you look at someone like a BillDesk, I mean, BillDesk did not kind of become a unicorn overnight. It was a 20-year-old journey, and probably someone who got in that early to even kind of understand how consumer behavior changes over 20 years, I think it requires you to have that kind of vision as an investor rather than just writing a check. Gaurav, coming to you and seeing it from a private markets perspective and long-term capital lens, if you look at typical consumer fintech, the play has always been pump in a lot of capital for aggressive growth and expansion. But if you were to look at it from a long-term lens and going to the point which even Anand was making, what are some of the growth patterns which signal a structural strength versus a very capital-intensive kind of expansion?
So I think things become obviously very clear and obvious when you are there for the long term, and one could define long term as, say, typically more than 5 years, 7 years, and in cases maybe 8 to 10 years that you hold. So, I'm not vouching for asset light versus asset model. Both can work in my experience. One may be harder, one may be not that hard. But I think on the, there are some very typical things which are pretty visible across businesses who have shown this structural resilience and the way they grow. I think one of the things could be, I think everything do around efficiency, I would say. This could be reflected in sort of various things like how much are, for example, your employees delivering on productivity. On the consumer side, it could reflect on, whether your customers, clients are buying more and more of that product again and again or not. It could reflect and repeat. It could reflect in same sort of retail businesses that you're doing both on the consumer side or financial services retail side. It could reflect in very interesting patterns that you can see in cohort data. Is your cohort sort of getting better and better with growth or not? So I think any of these things can reflect, I think the business is structurally doing better. Ultimately will reflect in what kind of ROAs or ROEs that you're getting in the business. Is it more efficient that way or not? On the flip side, if I look at businesses which may require a lot of capital to grow, that is the nature of business. There also, I think typical thing is that, if the business has to sort of be that multi-decadal business, resilient business, then beyond a certain time that it should not require more and more. The asset should not keep growing in parallel to the growth that the company is getting. And I think a very interesting signal would be, how efficient you're getting with working capital in those sort of businesses, which are the non-structural businesses, which is capital-intensive growth and all. If these signs are there over a long period of time, then it's fine. Even if your growth is slowing down, but sort of your margins are still improving, that should say something.
So Hero, all of the guys who spoke before you, they have the benefit of what happened before. But you are the guy, or BNX is kind of betting on companies much early on. And structure and many other things probably kind of fall into place when the organization has, it's not just an idea or a startup, but it's almost an organization. At the stage at which you guys come in, what are the signals that you look for that indicates that this can be big over a longer period of time?
Yeah. So you're totally right. In the early part of the journey, many things are not fully baked in. So how do you create your own secret sauce of combining qualitative insights with quantitative data points, whatever you may have, and you build out some sort of intrinsic value and option value combination that you think has properties to become sustainable and scalable over time. It's not that easy, it's difficult, but if you have a framework and process, there are ways to consistently look at outcomes. So in early growth, we do typically look at, for example, at accelerate businesses that are doing at least 50 crore or so in revenue, where we can deploy 50 to 200 crore type checks. Clearly, since business is not developed that much, we spend a lot of time in understanding founding teams' characteristic. There are certain things that we have seen work out very well consistently after studying 300 plus founding team across different sectors, certain characteristics that work. Then again, depending on the sub-industry or sector you are looking, if it's highly regulated industry, clearly you want to figure out who is the best jockey rather than finding the fastest stallion, because stallion will stumble, that we have seen 2 years ago when RBI came out with changes and a lot of fintech ran into trouble. So that's one part of our thesis and secret sauce. Second part is, are there early signs of product market fit? Are there customers who are using it? Are they discovering this product? Are they delighted? Are they spending more than what they started with? What is their feedback? Will they recommend it to their friends? So most of the time, there are only these 2-3 signals that are available in very early part of the journey. And clearly, if you see there is a coherence and there is a structure, you underwrite based on those signals and you identify what are the gaps where you can help them either in the scale, GTM, or leadership team build out, and what are some of the other areas which many times founder thinks are cost-centric, not revenue generating, but are exceptionally important to build a durable business, which is departments like HR, certain parts of the FP&A that should be there, otherwise you will have trouble at scale, which many of the established players which had private valuation of 20 billion plus ran into the trouble and disappeared. You don't want to run into those troubles. So you try to see how to build out all those things one by one. So there is a process, and in that process of discovery, by doing all this work over 1, 2, 3, 4 months and discussing these things with the founder, you have a good enough idea if there is a reasonable enough probability that it can evolve and develop into something big. Clearly nothing is certain, but seems like this process has worked well for us, so we want to continue in that process. So that's how we think.
Yeah, nothing is certain is the only certainty. So that takes me on to the next segment, and I'll start with you. So here we are going to talk about how capital allocation choices help in shaping scalable fintechs, right? So it probably continues to some of the points that you made as an investor, how you kind of spend time with the founders. Now, how should platforms balance capital deployment between, say, product depth and distribution expansion?
I think, so this is in my mind, it's a pretty nuanced question, and I'm not sure if there is a right or wrong answer. Internally, our philosophy is excess capital corrupts. We have gone through that trouble in some of our scaled companies already, and now we have corrected it. But we have also seen that whenever there are constraints in capital, it's mostly good because constraint drives creativity and innovation. So we prefer our founders to raise only the capital that is needed. If there is excess demand, you can keep an extra buffer, but you don't have to take more than what you need. It's similar to human body. You shouldn't eat more than how much hungry you are, very simple. And then once you have the capital, clearly you really need to see the marginal return on that capital in different projects, areas, how it will fit in and where there are, and you can divide that across different dimensions. So if business has achieved product market fit, it is in the scalable phase and it's in the B2B space, let's say, clearly you need to build out proper hunting and farming teams. So how do you allocate capital between sales manager versus account managers, and how do you recruit? What is the ratio between those? How do they work together? Are there other products that your customer need? If yes, how much capital will be needed to build out these products? How do you allocate capital, time, and resources into those? You do that planning. After that, if you are still left with excess capital that you need and there are adjacencies, you should always think on build versus buy approach. There is no right or wrong answer. If there are solutions that are better than what you can build or it can accelerate your time to market, can you get those solutions at attractive enough price point that should generate good enough ROCE for you at scale? That's another way to allocate capital. So it really comes down from company to company at stage which they are and what is needed. And I can give the example, our company, Fi Commerce, exceptionally capital efficient, really phenomenal team in B2B space, a really, really great team. On the other hand, we have also investments and pretty decent shareholding in neobank like Jupiter, consumer focused. They were very lucky to raise a lot of capital when capital was cheap, and we experimented with many different channels. Some channels didn't have the ROAs that we wanted, and capital got, if you look in hindsight, it looks like capital got wasted there, but they're also learning that which are the channels that work and how to deploy in those. Then we have businesses like Raise Holding, Dhan app, that raised a close to $21 million Series A, but at the trough, bank account has 16 million left by the time business became profitable because they were able to identify some of the channels at a much faster pace, and space has probably one of the highest ROCE in the almost any industry, so they were able to become profitable really quick. So it really depends from company to company, sub-segment to sub-segment, and ambition of the team, how to divide it across existing product versus new products versus people and M&A.
Yeah, and also in many of the cases where founders have been able to raise a ton of capital, probably before even the product was rolled out, it also goes down to the credentials and the credibility the founders bring. And then you can probably kind of figure it out as you go along. But for many of them who are probably building for the first time or haven't had that exit, I think it comes down to how judicious you're going to be and where you're going to put money to use, because that probably, I mean, raising capital is one thing, but if you don't know how to allocate it, probably that money is going to end at some point in time, and probably you're not going to raise that next round. Anand, I'll come to you with the next one. And a lot of times with founders, the ARR probably might sound inflated because you had that one big contract which kind of makes you seem like a company which is making a ton of money. But there's no assurance that you're going to have repeat business next year. And suddenly you are left wondering probably 6 months down that, okay, what happened now? Now, as Iron Pillar, as an investor, what evidence actually convinces you that unit economics and margins are improving sustainably over a period of time, rather than that one black swan event or a temporary kind of a spike, which makes the company actually look good?
Yeah, this is actually a classic conundrum that you should say. If you're looking at a company which is 10, 15 million, there had been situations where we have gone to a company with 10 million revenue with 40% of the revenue from one client who just came in. It's that kind of scenarios. Where we really go down is understanding what is actually really getting built here, number one. And is the company in the right trajectory of delivering the product, which really delight that customer? Because you can never go to, say, if they are selling to Amazon, as an example, X, you cannot go to Amazon and ask the question, oh, will you stay with this company for next year? Most probably they may say yes, but Mohanjeet, my partner, uses this term, vitamin pill to cancer drug. It's a spectrum, right? Are you actually delivering a cancer drug to something which is very fundamentally life-changing for your client? Or are you driving something which is easily replaceable? So we try to answer that question first. If the answer is that this is a very critical element, which is, there are two ways in which this become like an equivalent of a cancer drug, right? Now, one is, there is a big problem, you are pretty much the only one solving that problem, or you're one of the best solving that problem, right? So then the customer would most probably stay with you, because unless there is a 10x better product or 1 by 10 the price, typically people don't want to kind of rip it apart and change. Number two is whether you are what we call a system of records. There are certain industries where, I think about somebody like Bloomberg. Most of us, because in the financial service industry, we use that product. And that product is actually pretty poor UI, UX, but you still use it and you pay a lot of money because you don't want to get out of that system because you're just so used to that for 20 years using it. So it has to be that. That is actually the second hook which we look for, so that why it won't churn. And then if the revenue or ARR or whichever fancy metric people may use kind of sticks, then you go to the next question of, okay, fine, with this revenue, is there a fundamental unit economics at scale this business can deliver if they continue to do this over and over like 10 times? That's the way in which you think about it.
So moving from VC to PE, so Gaurav, what proves over a longer holding period that governance and economics are in place? What would you look for?
So I think, first of all, I think in my experience, it's an important part of underwriting any of the private equity investments, especially holding for the long term, even for the short term, I would say. So for me, at least I've seen, and especially when I think of financial services, fintech, obviously there are regulators, multiple regulators. Sometimes you don't like what they do, but you still, so I think governance should be a mindset. I think that is what I think should be accepted, that even if it's something that you may have a contrary view to it, but you still accept and move on. You sort of work with, especially in this financial services, fintech space and all. So that mindset is important. I'll tell you why I feel it's important, especially in the long term, when companies are, going to be listed, go for an IPO, what have you. That reputation of being high governance, that's very difficult to undo once you have that set, right? You may be labeled that way going into something. And then if I think of that as potentially long-term driver of value, that affects what kind of investors you attract on the table, ultimately, right? What kind of people you put on the cap table, private to public and so on and so forth. So I think that has to be sort of non-negotiable in my view. And sorry, the other part was economics?
So governance and economics. How do you assess governance and economics as durable over a longer period of time?
So in this way, I think the governance, in my view, would be a driver of value for the company in the long term. But I think economics for the business would come from, I think, see, if you're on the long term, you'll go through different, I would say, business cycles. So the fundamentals of the business have to be strong, that they go through different business cycles and they retain. And I guess certain things which are probably not dependent on those business cycles should sustain. For example, things like, I think like Hero mentioned about capital efficiency, right? What kind of alignment do you have between your partners? What kind of characteristics that the founders carry? For example, are they resilient? Are they perseverant? So I think those things will matter. And obviously, I think how true do you stay to execution, something like execution. I think those will define what kind of economics you deliver in the future.
I'll go to you, Varun, with the last one. So in your experience, what kind of capital allocation mistakes typically have delayed the overall profitability or have compressed valuation when they are looking to raise their next round?
Yeah, absolutely. So I think, for all our portfolio companies, we do advise them that when you're making capital allocation choices, you always think of what you need here and now, what gets you growth and durability for the next 2-3 years, and then your moonshots that help you to drive growth 5+ years onwards, right? And you need to have 2 or 3 bets in each of these, I would say, segments, and need to prioritize constantly within those segments. So that is table stakes. But what I've seen typically capital allocation mistakes that actually set you back big time is one thing that's not very obvious, I would say, is knowing your circle of competence. Buffett, Munger, they talk about this. But as managers, it's very important to understand what your right to win is, where do you, quote unquote, have an unfair advantage. I'll give you an example of that from an experience, a company that I evaluated in the fintech space. It was a great enterprise fintech company, solid product, doing really well. But they ended up venturing into a new customer archetype that they were not familiar with a new product that they wanted to actually co-build with them. What that ended up was that the learning curve was so long that the company ended up losing not only hundreds of crores as part of that long-term contract, but it cost in terms of management distraction, right? Your CXO layer is spending days and days trying to fix a broken hole, and those mistakes can set you back years in terms of your roadmap, your scale, and also can have a long-term knock-on valuation. So again, I would say very important to know what you do well, what is your circle of competence, what's your right to win, and stick within those swim lanes. It'll hold you good. At least that's been my experience.
I'll come to the last segment, and we'll keep this kind of short so that we can finish up on time. So while scale is important on one hand, you're also trying to drive outcomes. And the outcomes that typically one tries to drive is around the valuation, the trust, and the all-important exit readiness. So Varun, when you look at global investors, how do global investors assess trust in fintechs operating in regulated markets like India?
Yeah, I would say, I would say they're primarily looking for durable and defensible business models that have, again, a differentiation that is sustainable. What does that mean? Right? Think of for a B2C fintech business model, do you have a differentiated credit model that helps you win in the marketplace? Is your way you acquire a customer different versus how everyone else is doing? So it's very important for you to ask yourself, and as we as investors ask ourselves, why is this company winning and is that sustainable? And so long as that's true, we see that there is multiple years of compounding that you can achieve, and at exit, public markets tend to reward you for that as well. So in a B2B enterprise fintech context, that could mean do you have a differentiated product? Do you have proprietary data modes? Are you working on regulatory workflows that make you very embedded and hard to rip or replace? So again, I would just underscore that about the durability and defensibility and the differentiation of your business model, and that a lot of time, and apart from that, obviously your team, stable leadership team that works well together, executes strongly. I think we've seen these two are always a winning combo. So that's what at least we focus on.
Gaurav, in your IPO and exit experience, how and where do the governance quality and overall institutional readiness influence the valuation outcomes and exit execution?
I think on governance, I would say similar what I answered earlier was, I think it sets the tone of what kind of investors you attract for the future. I think, and then that keeps going on. It's very hard to undo. So that mindset is very important from a value. At least the value doesn't get destroyed if it doesn't get incrementally increased, that it stays on course. But of course, there have been instances that I think there have been premiums paid for. In my view, I think if you are in an industry which is known for bad governance and you are standout, you shine like a diamond, right? Then you get a premium. But generally speaking, it doesn't destroy value as long as you have the mindset. You get the right set of investors. I think execution is, I think, not so far away. We went through the experience of Go Digit General Insurance. I was an early investor there. We went through the IPO and all. I think the timing is critical for maximizing value for your investors. So therefore, execution is extremely important. There's not much room to make mistake. And especially when you are in this environment that you have to deal with multiple regulators, which you have to, and there are strong processes to be followed. If you drop the ball on execution or you make mistakes, it goes into quarterly loops of approvals and approvals and approvals, and by the time you sort of spill over to the next year, and you might miss the timing of it. Hence, obviously, execution, in my view, has a massive impact, potentially, that you don't miss the thing that you've been waiting on for so long, that you get into this quagmire. So both are important.
So Anand, so execution, and what I was thinking of is profitability is a big moat to have. So when you're looking at a founder trying to balance or think about the near-term profitability because of the pressures that they might have for the company they're building, but you as an investor, how would you advise founders to balance that near-term profitability with building a long-term defensible scale?
So I'm going to go back to what they are actually building. Look, you can build a profitable company from, you could be a $50 million, 20% EBITDA business, which compounds every year, say 20%. But then you should also know that the next buyer, whether it's private equity or public markets or whoever it is, would give you probably 20 to 25 times EBITDA. That would be the outcome which you're looking at, right? So that is one set of, if people are looking for and happy with that outcome, go for it. Nothing wrong with that. People have made a ton of money doing that. But on the other side, and this is where I see the dichotomy, people really want to build market leaders, massive companies of consequence. And this is a data which I think in the startup industry also many founders don't really get it. If you look at Indian public market today, there are 578 companies which are over $1 billion in market cap. What does that really mean is that there is only 400 companies of consequence. The first 50 which are large cap, next 150 which are mid cap, and in the small cap, say maybe the top 100, if not 150. So that means 400 companies. The line of that 400 company today is 1.8 billion in market cap. So if you are a unicorn and you go public, which is supposed to be a great deal, you're nobody in the public market. That is an important message. If you want to really be somebody of consequence, and if you're building a company today, that line is going to, by the time you go to public market, say 5-6 years, that's going to be a $3 billion company. So you got to be in a large market like India, should be aiming for $5 to $10 billion outcomes if you really want to be consequential. And that would require a very different kind of thinking. That's the advice to founders.
I come to you. The hero obviously speaks last. But yeah, amongst the companies or the fintechs that you're back early on, what kind of founder mindset and early decisions have you seen that have strongly influenced the kind of premium valuations that they've got at a later stage?
So most of the companies that I have bagged, they haven't got any valuation in the beginning, and later it has improved. And mostly the characteristic are the founding team is very resilient. They are building it right way. When you build right way, it's like building a house. You need to put the base. So knee, when you put the knee, you need to really dig deep so that the house is very stable and sturdy. It's exactly the same thing. In early days, you need to build out all the processes, everything. You need to recruit the right people. You cannot take the shortcut, because if you chase the growth, it will become empty calories growth that may not repeat there. Anybody can raise capital in the beginning and chase this empty calorie growth, but if you don't put the processes, you won't have things that are scalable. So what happens is that in the early days, it looks like these companies are not growing fast enough, founders are slower, but other way to look at it is actually they are putting all these processes that will accelerate growth at scale. And these companies will have the ability to compound for very long time that others won't have, because at scale, when you try to put out the base, you end up making a lot of mistakes. And many of these things we learn from our own companies, so we realize that in early characteristic, you really need to be very focused on these processes. You need to have perseverance and persistence to build these out in a very resilient manner without any, without listening to any advice from any of the investors or anybody else. That's what we have seen. Yeah.
Awesome. Thank you so much. I think we are already beyond time, so no time for questions, right? Maybe one or two questions?
Yes, sir. Question to Mr. Hero Choudhary ji. So, how you perceive the role of the regulator, RBI, in these investments? They are gatekeeper or speed innovator? How it?
Actually, we do like RBI a lot, and the reason is if you are building a business in the right way, eventually whatever RBI does, you will come out on the right side of that, and that will actually become a moat for you over time that will be extremely difficult to arbitrage away. We have been very lucky to be on the right side of everything that has came out so far, considering how high fintech exposure we have. Across my accelerate funds, I have close to 40% exposure in fintechs, and we have been very lucky. And just to share the example, the day, I think it was July 2024 or so, the day Paytm, PayU, and I think one more company, their PA license was denied. Same day, in the news piece, there was buried that our payment company, Fi Commerce, they were principally approved. They were the 13th player to get approved, where nobody knows what this company is. But RBI knows how well they think about regulation, these founders, some of these founders, and how they are building out. And we are actually very comfortable to take that regulatory risk because we think it's not a risk, actually it's a moat if you do it right way. Something similar happened to us in Raise Holding Dhan. A company that I did is highly regulated by SEBI, different kind of regulator, but kind of more conservative than RBI, I think. And being on the right way, building out the right processes, doing right way, goes very long way. And that helps you in avoiding the mistakes if you are taking if you are cutting corners, which happened with some of the prepaid card companies or other companies where they have to really change a lot of things. So it's a good way that you don't play in the gray area, because in gray area by playing you can build out a scale really fast, and unit economics looks great and you can raise capital. But if you go deeper and you realize there are these loopholes, that RBI will eventually come because they want to protect the consumer. They want to make sure there is no systematic risk. And at scale, some of these can become the risk. So I gave this example, but short answer is we really do like it, and we think regulators are as much aligned as the founders for ecosystem to grow. So it's a pretty good moat if you pick up your spots properly. Yeah.
And just one 30-second question more to all of you. How you perceive the growth of fintechs in Gift City, IFSC?
I just want to share that I had in Speaker Lounge, I had a very good discussion on this topic with one of the founders, and I was blown away with what she was proposing, because I think somehow to me it seems like it may be the next phase of growth to come. And to me it seems like today there are very low expectations, which means scope may be much higher, and there may be many more new models that you can expect to come. But I really know that I don't know 99% of the things to speak intelligently on that, but that's my feeling.
Thank you very much. Thank you.
Great. We can wind up. Thank you. Thank you so much for being wonderful panelists.
Thank you.
Thank you so much, Ajay. Can we please give our whole panel a huge round of applause, ladies and gentlemen. Once again, thank you to Mr. Hiro Choudhary, Mr. Anand Prasanna, Mr. Gaurav Sekhri, Mr. Varun Telaprolu for sharing your valuable insights. And thank you, Mr. Ajay Ramasubramanian, for moderating this discussion. Okay, we have the whole team. Let's go for the picture.